Hello, grade 12. Today we are once again looking at paper 1, grade 12, that was written in September 2024 in the Eastern Cape province. And I just want us to focus on question 3, which is the interpretation of financial information. So this question was allocated 40 marks to be completed in 30 minutes. Okay, so when you are doing a question like this that is heavy on writing, and most of the time the answers are right in your face, not necessarily, but at most times you would need to explain, you would need to quote figures, you would need to mention differences, you would need to talk about the trend. As you might have known from previous videos, when we do a video or a topic that is heavy on writing, heavy on commenting, we need to make sure that each and every time you mention all those things to ensure that you bag all of the marks. Okay, so to begin with the question, it's Luca Ltd. So the financial year ends on the last day of Feb each year. Okay, so it's Feb 20. So here they haven't really given us 20 something, but it's just the last day of Feb each year. And then we know that it begins on the 1st of March. Okay, which is going to say H. Yeah, okay. So we are required to note where comments or explanations are required. You should quote financial indicators and trends with figures, like as I've just alluded. So we have financial indicators, trends with figures. Okay, so by trends they mean that if something has increased or decreased. Okay, you need to mention that. You can also mention the differences. It decreased by this, it decreased, it increased by so much. Okay, so you need to also give a reason or an explanation for the financial indicators you quoted. Okay, and then 3.1, we are given concepts relating to companies, which are given in column A, and descriptions in column B. Now we need to choose the description in column B that matches a concept in column A. So write only the letter A to D next to the question numbers 3.1.1 to 3.1.4. Basically, we're just matching column A and column B. So the first thing that we have is gearing on 3.1.1. And when we look at option A says indicates the benefit that the owners receive from their investment in the business, and that definitely doesn't look like gearing. And then when we read information B, it says indicates the extent to which the business is financed by borrowed capital. Okay, so that definitely sounds like gearing, and then gearing is B, because when we're looking at gearing, you're looking at the extent to which the business is financed by borrowed capital, which includes your non-current liabilities. Okay, this is borrowed capital, which talks about your non-current liabilities and how much we use such to finance our business. Okay, and then when we look at 3.1.2, which is solvency, and reading information or explanation C, which indicates whether the business will be able to pay off all its debts, which is definitely what solvency is. So here we have C, and then when we look at 3.1.3, which is liquidity, and reading information D says indicates whether the business can pay off short-term debt. Okay, so this is the huge difference between solvency and liquidity, because liquidity is short-term debt, and then solvency is all of its debts, including the non-current liabilities. Okay, so here we have D, and then the return on equity is what we receive as a benefit from our investment in such any business. Okay, so it's B, C, D, A, and then let's check our. So this is B, C, D, A. Okay, that's our answer book. And then 3.2 says profitability. Quote and explain two financial indicators which indicate that the company manages its expenses more efficiently. So when we look at profitability, we're looking at the ability to maintain expenses and actually be able to make profit, right? Because as soon as you know that you are able to control your expenses, you are going to have an increase in your profit. Okay, and then when you are making more sales, okay, if you're able to make more sales, you're going to be able to make more profit. So these two things go hand in hand. When you control expenses and when you control your sales, you're going to definitely have much more profit. So the financial indicators that we need to look at is our percentage operating profit on sales, or also um, any other indicator that could indicate that we're doing well on our expenses. Okay, so we're given information. We have information A, which is financial indicators calculated on the last day of the financial year. Okay, so we have the percentage operating expenses on sales. And what else are we looking for? We're looking for our percentage operating profit um, on sales. Okay, now when we look at these numbers, we're going to look at the percentage operating expenses on sales first. In 2023, we had 23.32%, and in 2024 we had 21.6%. Okay, so this means that our operating expenses were only 21.6% of our sales. Okay, so let's get to understand the ratio and what it means to us. Our operating expenses last year were 23.2 of our sales amount, but this year they are only 21.6, which means now our expenses are of a lower portion of our sales. Okay, so we have our percentage operating expenses on sales were, okay, now we're quoting figures, were 23.2% in 2023, or this is 2023, and 20, I think that's 21.6, okay, 21.6% in 2024, which decreased. Okay, now we're going to mention the difference, which decreased by, so it's 23.2 minus 21.6, and then that's 1.6%. And the second one we're going to look at is our percentage operating profit on sales. Okay, so in 2023, we know that our profit was only 19% of our sales, but in 2024, our operating profit on sales increased to 21%, which means that we were able to control our expenses there slightly, and we had an increase of 2%. Okay, so percentage operating profit on sales. Okay, think about when we do our income statement, when we're talking about the operating profit, it should be your gross operating income. Okay, gross operating income, just to jog your memory. So this is your gross operating income, and then you subtract your operating expenses, and then you get your operating income. Okay, so that's it. Now when we look at the operating percentage operating profit on sales, we know that in 2019 it was 19, 2023 it was 19%. Okay, so here we can just say increased by 2% from 19% in 2023 to 21%. Okay, to 21% in 2024. Okay, we've done the quoting of figures, we've shown the trend and the difference. Okay, so this is the trend This is the difference, right? So that is what you basically need to show, or basically write, whenever you are required to quote and explain any financial indicators. Okay, that's 3.2, and then now we're going to move on to 3.3. So 3.3 says liquidity. All right. So it says suggest strategies that the company can employ to improve its net working capital. Okay. So we're looking here at the net working capital. And when we're talking about net working capital, we know that we're talking about mostly our current assets that we simply use to convert them into cash, right? So that we can have enough cash flows in the business and we are able to continue running. Okay, so we need to look at ratios that include our current assets. In this case, it would be your asset test ratio. Another one could be your current ratio. Another one could also be your average debtors collection period, because whenever we have our average debtors collections, we need to ensure that we are able to recover cash or receive cash from our debtors so that we can be able to continue with operations in the future, such that as we receive cash, we are able to continue having enough cash flows in the business. Okay. So the first one that we're just going to look at is our average debtors collection period. So when we're looking at that, we can see that in 2023 we had 29 days to collect our debtors, but in 2024 that is now 42 days. Okay, that is 42 days that we have taken on average in 2024 to collect our debtors. Okay, so now let's just do that. We know that here we have our average collection debtors. Okay, let's correct that. So that's debtors collection, average debtors collection period increased, okay, from, or let's just say the difference first. Okay, so it's 42 minus 29, so increased by 13 days from 29 days in 2023 to 42 days in 2024. Okay, now it's all up to your strategies and what you're thinking. Okay, based on the numbers that we had, in an increase in the average debtors collection schedule is something that is not good for the business. It shows that we're unable to receive enough cash on time to continue with our operations. So we need to ensure that we are able to receive much more cash on time. Now we need to think about how can we actually encourage our debtors to now pay us on time. The first thing that I usually think of is usually charge people interest so that they are able to charge you on time, or to pay you on time rather, so that they are not charged interest. Okay, so charge interest on overdue accounts. Okay, that's the first thing I could think of. And then something else that you could do is offer discounts. We're looking at the opposite now. Offer discounts for early settlements. Okay, early settlements, or you could just say simply payments. Right. And then now we're going to look at the second one. Looking at the second one, which I talked about, was the asset test ratio. So now here on our information A, the asset test ratio that we had 0.6 is to 1 in 2024, 1.3 is to 1 in 2023. Okay, so the asset test ratio shows us how much cash we can be able to generate without the sale of inventory. So if, let's assume we say our stock was to come obsolete, or we could no longer sell all our stock, and then how much of our other current assets can we use to generate income? Okay, so that's what the asset test ratio just shows. Okay, now we had a decrease from 1.3 is to 1 in 2023, and then here we had 0.6 is to 0.6 is to 1 in 2024. So this decrease now shows that most of our current assets consists of stock, because when we decrease or when we subtract stock from our current assets, we are left with a small number of other current assets. Okay, so it means that we have much more stock on hand. We are not making enough sales on stock, because it means that our stock is a huge part of our current assets. Okay, so we're going to say our asset test. Okay, let's do the test. Ratio decreased from 1.3 is to 1 to 0.6 is to 1. Okay, so this was 2023. This is 2024. Now, since I've mentioned that we have much more stock on hand, what we could do is to promote the stock, basically just do much more advertising, or maybe we're charging more prices. We will need to therefore decrease our prices to increase sales. Okay, so here we could reduce prices to increase sales. Then you can also do advertisement and promotion of stock. Okay, promotion of stock to increase sales also. Right, and then we're going to move on to 3.4. So 3.4 talks about financing strategies and gearing. So whenever we're talking about gearing, we're talking about liabilities and borrowing. Okay, the first bullet point of 3.4 says comment on whether the company is making good use of loans. Quote one financial indicator with figures and trends. Okay, so in this case, we need to talk about the use of loans. If the company is making good use of loans, okay, we know here we usually focus on the ROTC or ROTC, because we need to check the return on total equity or total capital employed. Okay, not equity, sorry. We need to look at the total capital employed, which is our finances. Okay, finances, which here we're talking about what we have used to finance our assets, what we have used to build up the assets of the business. And then secondly, we need to talk about the debt equity ratio of the company decreased from 0.8 to 1 to 0.6 is to 1. So mention two possible reasons that could have led to this change. Okay, so let's focus on the first one first. When we look at our percentage return on capital employed, which should be this one. In 2024, we had a decrease of 19 point. We had a decrease from 20.3% in 2023 to the 19.8% that we see there in 2024. Now, what does this mean for our business? So, if we are going to look at our ROTC, we need to look at the interest on loans. Okay, so the interest on loan is in this case 13%, also in 2023 is 13%. But if we are able to make a return that is higher than what we could have paid or what we could have been paying on interest, which is 13%. Okay, so basically, if we would have made a loan, we would have been paying 13% interest, but the business is being able to get a return of 19.8% on those finances, on those loans. Okay, so our overall profit could then be 19.8 minus 13%. So the rest comes to the business. Okay, so we were able to use the loans effectively, right? So Now we are going to look at okay, 3.4. So the percentage return on capital employed, okay, decreased. It decreased. Okay, we know it decreased from 20%. Okay, let's just make sure it's 20. Oh, it's 20.3. Okay, so it's 20.3% in 2023 to 19.8%. Let's just make sure of that. Okay, 19.8% in 2024. Okay, even if it decreased, it is still above the interest on loans. You can just say loans of 13%. Therefore, loans are used effectively, because remember what the question was asking us. We needed to determine if they're making good use of loans. Okay, so loans are used effectively, or they are fairly used. Okay, and then now we need to look at the debt equity ratio of the company, which decreased from 0.8 to 1 and to 0.6 is to 1. Now we need to mention two possible reasons that could have led to this change. All right, so now we know that our debt to equity, it's we're talking about our non-current liabilities, and we also need to talk about our equity. So one of the two could have happened. We could have either repaid the loan, or we could have issued a new number of shares. You know that when you issue new shares, you could have an increase on your equity. Now, when you are repaying a loan, you know that your debt is going to decrease. So then you're making less use of loans, and your non-current liabilities decrease. So then you would have a lower debt equity ratio. Or on the other hand, you could have had an increase on your equity. When you are issuing new shares, your equity increases. So those two things could have happened. So here we could have had a decrease or payment of a loan. Okay, or we could have had issue of new shares, resulting in an increase of equity. Okay, and then we are also going to talk, we could also talk about having an increase in profit, which could increase our retained income, and of course our retained income also increases our equity, but that's a bit of a long way to go, but you could also consider that. And then just quickly moving to 3.5. Okay, so 3.5 from the question says dividends, earnings, and returns. The first bullet point says comment on the dividend payout policy of the company. Okay, looking at the dividend payout policy now. When we're looking at dividend payout policy, we want to determine the earnings per share and how much of those earnings per share do we pay out to our shareholders. And then we need to provide two reasons why the directors decided to change the policy in 2024. Okay, so let's look at our earnings per share, and then we look at our dividend payout rate. Okay, so our earnings per share, when we look at it, we can determine that there was 70 cents, and here there was 78 cents in 2023. And then our dividend payout rate was 103% in 2024. That's a bit aggressive. We've been paying so much of the profits to the shareholders in 2024, And then in 2023, we're only paying out 51% of those earnings. Okay, so here we're just given the dividend payout rate. We can actually just use that. Okay, so let's quote our figures first. So dividend, okay, that's dividend payout rate. Okay, increased from, oh, let's just first that state it increased by the difference between that's 51% and 103, it's 52%, almost double. Okay, increased by 52% from 51% in 2023 to 103% in 2024. Okay, so that's quite a big jump, almost double. Now we need to talk about the reasons why would we pay out so much to our shareholders. The first thing is that whenever you are retaining much more dividends, or I would say the income or the profits of the business, you would just use that income to build more, invest in more things into the business, you expand. So now when you are actually paying this much to the shareholders, it shows that you don't have any plans to actually take the money back into the business, reinvest it, and expand on any future plans for the business. So here there could be no plans for future business expansion. And then another reason could be that we want to make just simply our shareholders happy. So keeping shareholders happy. Okay. One other reason, you could be attracting potential investors. Okay, that's also a valid reason that we could input, attracting potential investors, because as soon as investors can see that, okay, this company is paying so much more dividends, I actually want to invest in that company, so I can have a high return on my investment. Then an investor could just pop for that company. Okay, so now, we also need to explain again whether the shareholders should be satisfied with the return on their investment in the company. Now, quote a financial indicator with figures. So here we're looking at the return on their investment, which is our share. So the return on shareholders' equity, okay, just above our percentage return on total capital employed. So here, when we are looking at the ROCE, we know that the ROCE was 11% in 2023 and became 12.8% in 2024. So that's actually a good thing because it has increased. But now we need to compare that to our other alternative investments that our investors or our shareholders could go to. Okay, if they chose to get a fixed deposit, they could be getting 8%, but here in the company they're getting 12.8%. Okay, so that's what we are going to focus on. So our percentage return, okay, let's just say the ROCE increased by, okay, so let's look at the difference. So that's 11, so that's 1.8%, increased by 1.8% from 11% to 12.8%. Okay, then 2023 and 2024. Okay, so it so it is still above the interest on fixed deposit, okay, of 8%, which is our alternative alternative investment. Okay, and then that's our return on investment in the company for our shareholders. So therefore, shareholders should be satisfied. Cool. And then we are needed to calculate the dividends that were earned by a friend who owns 40,000 shares in the company on 29 Feb 2024. Okay, now let's look at the information. Okay, so they just said on the question, calculate the dividends that were earned by a friend who owns 40,000 shares in the company on 29 Feb 2024. Okay, so this person owns rather 40,000 shares, and we need to determine the dividends that were earned. Okay, so we know that the dividends per share, okay, dividends per share was 72 cents in 29 Feb 2024. So that is 72 cents, and we know that they have 40,000 shares. Okay, so we're just going to simply calculate that. So it's 72 cents multiplied by 40,000 shares. Okay, so we're going to take 0.72 times 40,000, and then we know that that is 28,800 in dividends. Okay, and then 3.6, let's look at the question. 3.6 talks about the value of shares. The CEO wants to sell his 60,000 shares back to the company at 1,250 cents per share on 29 February 2024. Okay, we know that it is 60,000 shares back to the company at we could say 12 francs 50 if the cents are going to confuse you. So that's 12 francs 50 on the end or at the end of the year. So, as a shareholder in the company, how would you react to this decision? Okay, so we are the shareholders of the company. Now, we know that we wouldn't really just accept the price. We would need to look at a few key factors. We would need to look at the actual value of the shares of the company. Are they buying these shares at an amount? Are we buying back these shares at an amount that is high or ridiculously high? Or are we buying these shares for a bargain because they would be less than what we actually value the shares at? Okay, and then this is where the net asset value per share comes in. Okay, we're looking at our NAV, and then when we look at our net asset value that we have here in 2024, it is 950 cents, and then the market price per share at JSE is 934 cents. Okay, so if we were to buy shares back through the JSE, we would have been paying 934, but in our books we value these shares at 9 rand 50. But this person is selling those shares to us at 12 rands 50, which is actually at an amount that is higher than what we value these shares for. So it's at a premium. Okay, so we are going to talk about the right. So we know that the net asset value is at 9 rand 50, and the selling price. So the selling price is 12 rand 50, which is greater, okay, by, okay, so let's see the difference. 12 rand 50, okay, by 3 rands or 300 cents. Okay, or you could also talk about the percentage difference between the two. Okay, now something else you could also talk about is the market price and the JSE. The JSE values these shares at 934, but this person wants to sell them to us at 12 rand 50, which is, I think, a bit ridiculous. So now we need to come up with an explanation, okay, as to explain and quote one financial indicator. Okay, how would you react to this decision? So now we need to talk about, as being the CEO, or rather the counterparty of the company, how would we react, okay, when someone wants to sell us shares at a higher price? Okay, so the first thing that I would definitely mention is that the repurchase price is just a bit higher than what we value the shares at. Okay, so repurchase price is higher or greater than the NAV. Okay, because we've talked about the NAV here, we could just stick to the NAV, or you could talk about the market price if you choose to talk about the market price, which is unfair for the company. Okay, it's a bit unfair to buy shares at a higher price. So now, this what the CEO is doing is actually trying to get some money from the company, because maybe they do know that they have the company has much more money to pay for these shares, so they're using their position to actually gain an advantage. Okay, so CEO may be using their position to gain an advantage. Okay, to gain an advantage. Okay, so those two reasons could be enough. And then now what we need to look at is 3.7, which is just the last question before we finish off. So 3.7 says, calculate the number of shares that John Kahn purchased from the 250,000 new shares issued on the 1st of Feb 2024 to retain his majority status. Okay, let's just get some information about this transaction before we can begin. So shareholding. So refer to information B. Calculate the number of shares that John Kahn purchased from the 250 new shares issued on 1 Feb 2024 to retain. Okay, that's basically the same thing. Okay, so we know that there was 250,000 new shares that were issued on the 1st of Feb 2024, right? And which information are we going to look at? Information B. So the share capital and shareholding of John Kahn. Okay, we know that in 2023 there were 650,000 shares, and he had a shareholding of 51%, right? So this year he has 50.1% shareholding, and we do not know the number of shares that are in issue. Okay, so in this case, we are going to first determine the number of shares that he owned before. Okay, I think it's much better to do that. We know that there were 650,000 shares multiplied by 51% that he had. Okay, so 650 multiplied by 51%, which is 331,500 shares in 2023. And then in 2024, okay, we need to add to the 331,500 shares such that he will then own 50.1%, but also there's an increase in these number of shares. Okay, so we know that he owns 50.1%, right? And this 50.1% share, and we know that 650,000 new shares. Okay, so 650, so 650 plus 250,000 shares that were issued. Okay, that would then give us 650 plus 250, which is 900,000 shares. Okay, and for 900,000 shares, for you to have 50 plus 1%, you would just say 50. Let's just determine the 50.1 multiplied by 900,000. Okay, times 50.1%, you would need to have 450,900 shares. But we already know that he has 331,500 already from last year. So we would just take the 450, 900 minus the 331, 500 that he already had, and then he needs to purchase an extra, or he has purchased an extra of 119,400 shares. Okay, so that is our question for today. Thank you so much for watching. I hope that was really useful. Do not forget to subscribe, like, share, and drop a comment on any accounting topics or questions that you might have. Please feel free to share with your friends, family, and anyone who might need help with accounting. I'll definitely see you in the next video. Cheers.